Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing Uber Technology stock. This one came in by request down in the comment section of one of my other videos, and I've kind of been holding off on analyzing it to wait for them to go ahead and report earnings. And they've done that now, so it gives us a little bit more of a clear picture on kind of what's happening right now. As always, this isn't individual investing advice. This is just how I analyze stocks. If you have any stocks you want me to analyze on the channel, just drop them down in the comments section. I'll get them on the whiteboard behind me, and I will make a video. If it's a stock that's in the S&P 500, I post those on YouTube for free. The rest I post on Patreon and in the full Cyclical Investors Club service on Seeking Alpha. If you join Patreon for $5 a month, you can get a big discount on the full service if you ever decide to join there. Also, I'll be using fast graphs, which I usually use here to analyze stocks. And if you want to check that out, there's a 25% off link down in the description. And it helps the channel out. I get a little commission if people come through there. Other than that, I pay for my Fast Graph subscription for the past like 5 or 6 years. So I'm not getting anything for free. But okay, back to Uber. So I have certain categories that I put stocks in, and Uber would fall into the fast growth kind of category where they're in relatively recent IPO. So they IPO'd, it looks like, around 2020 or maybe late 2019. And for these, they don't have enough historical information to really know how they're going to perform in a recession. So you kind of have to have a different mindset and strategy when investing in them. For me, I think when you invest in earlier public or earlier stage growth companies, less proven growth companies is maybe another way to think about it. It's usually they trade at pretty high valuations if they're growing, sometimes even if they're not growing. And so for me, these are long-term buy and hold positions. So you want to place a bet that this company is going to grow enough to make up for that high valuation. So like in Uber's case, it's like 80 PE right now. So they need to grow a lot in order to justify, they need to grow earnings a lot in order to justify that PE ratio, and they need to compound over time. So there's kind of two different types of growth businesses that I kind of categorize them into. Once they're good enough quality, and I think Uber has kind of shown now that it is. Everybody knows Uber, and they're earning money now, which is this dark green area in the fast graph. So, but they are also quite big already. So they're already a $145 billion market cap business, which is very big. And the danger here is that they're already everywhere pretty much that they're going to be. Now so that limits the amount that they can potentially grow. I would say their business scales pretty well, but there are regulatory issues and things that they already have ran into in various places. So you want to be a little more careful with these giant ones. It's a lot easier for a $14 billion company to grow into a $140 billion company than it is for 140 to grow to like 1.4 trillion, right? So that should always kind of be in anybody's mind when they're looking at a mega cap, almost a mega cap tech, at least a large cap company already that's trading at a really high valuation. But with technology companies, they can scale a lot easier, as we've seen recently with Meta. They can also adjust, so it's not impossible that they could grow over time. But the way I would think about this is probably for these larger companies, think 15% earnings growth on average for 15 years. So you really need to expand your time frame out farther in the future, which is difficult to do. I think I did it with Netflix is a good example, where back in, 2 years ago, I bought my first Netflix position a little a little less than 2 years ago, and using kind of a growth strategy. And my mind then was Netflix is already big, everybody knows about Netflix, but they could still grow probably 15% for 15 years. And being the leader, they can probably fend off competition fairly well, which is what we've seen Netflix kind of do, expanding ways that they can make money from their subscriber base. So Uber kind of fits in that same category. I mean, it's not crazy to think that they could grow 15%, grow earnings 15% a year compounded for 15 years. If they go into other areas, if they monetize better, if they end up being way better than their competition and so forth. So it's not crazy to think about that they could do that. So the question then becomes, what should you pay for that if that's kind of like your rough assumption? Assume you're going to hold for the long term and try to get it at a fair price with that assumption. So I have a specific strategy that I use in the Full Cyclical Investors Club service that's exclusive to that service, but I'm going to share kind of a shortcut way to do it, just to keep you like in the right ballpark. If you think in your mind, okay, Uber can probably do that, I just don't want to pay like too high of a price for it. So that's kind of what I'm going to show you here. So they are earning money, so that's good. Sometimes you can do this right before they earn money, which is good if you can get it kind of in this area and then get this double, which we've done on a couple stocks. I wasn't really following Uber too much because they didn't look like they were going to make any money. I mean, but what you can do here is if you go into forecasting calculators, for most stocks, what I would do is just go forward 2 years and look for like a 30 PE. If you think this is a business that can grow like 20% for 10 years or 15% a year for 15 years, that kind of works out to roughly the same math. And if you look to like a 30 to maybe a 33 PE, given Uber's size, I would be more conservative. So like a 30 PE 2 years from now. So what you're willing to do is look forward 2 years and give them the benefit of the doubt is basically what you're doing here in terms of growth. And when you do that, like a $58 to $59 price is kind of what you would be looking at. So that's the super quick way. I definitely wouldn't pay more than that for the stock. That doesn't mean the stock can't do better, but chances are you'll be able to pick it up at around that price at some point over the next couple years, especially if there's an economic slowdown or any bad news or anything like that, because expectations are pretty high for them. Now, with that said, earnings are expected to grow by analysts 100% over the next 2 years. That to me seems optimistic. So I like to be a little bit more conservative. I really don't know what they're going to do, but I mean, nobody does, right? So you can go into this custom bracket here, maybe. There we go. In Fast Graphs, and you can enter what your own growth rates are. So for me, they are still probably going to grow pretty fast, like more than 15% or whatever. But if you want to get a good, like what I would do, just to give a quick estimate, I would use 20%. So I'm going to get my calculator out here really quick and calculate what earnings would be if they grew 20% next year, which is about $1.04. So I can enter in, maybe, there we go. I can enter in $1.04 in earnings. That should be about 20%. Maybe we'll do $1.05. We'll be a little more generous. Get it at least over 20%. There we go. So over 20%. And then I'm going to do one more year because we're willing to go forward a couple years and pay up front basically for a couple years worth of earnings, and then hope after that they can kind of maintain maybe like a average fit. Remember, it's an average growth rate for a long period of time. So they could have these faster years first, but at some point they'll slow down and the stock price will usually plummet at that point. So you want to keep that in mind, that even if they do grow, it's not always going to be at a steady rate. So this comes out at $1.26. Okay, so now we can go in and at a 30 PE, we want to see what we would pay for the stock. If it averaged 20% the next couple years at a 30 PE, kind of what would we be looking at paying? And let's see, that's 24 PE, 27, 33. We're skipping all the way to 33. I don't know if I can remove one of these so I can zoom in a little bit more. Hold on just a second. See what my options on zooming here. Doesn't look like I have a scroll bar for that. Okay, let me just see if I can get in here. I want to try to get in on the 30 PE if I can. There it is. So $37.80 would kind of be what I would be aiming at with that. You're like, okay, they can probably do 20% for the next couple years on average. What's a fair price to pay? Like $37 or $38. Right now the stock is trading at 70, so maybe like 45% lower from here would be where you would say, if you were optimistic about the long term, where you could come in at a fair price. And that's pretty close to where my actual buy price is using my other method in the full service. So hopefully that gives you something to aim for. I do think the stock is expensive here, but it can get more as long as these growth. When I looked at their revenue growth was only 15%. Traffic growth was a little over 20. A few of the other metrics were a little over 20. So assuming 20, for revenues growing 20, maybe they can cut places and get more lean and scale and things like that, and so earnings can be better than 15, which is what revenue is growing at. But when you're thinking the long term, you need to keep in mind that it's going to be very hard for them to grow at the rate that the market is short term. So they're probably pricing like a 30% growth rate for the next few years, or probably 40%. And that's why the PE is so high. Very difficult for a company their size to grow that much. Really, the only one that I've seen lately that's surprised me on that end has been Palo Alto. They really surprised to the upside, and they were a big company, So it does happen. It could happen with Uber, but you play the odds. And for me, I mean, it's pretty aggressive to even assume like 15% for a long period of time on average. So, I mean, I think, and look, the stock price was just, what did I say, 38 or something? I mean, it was just, how many? Less than like 3/4 of a year ago, it was trading at that price. So it's not unreasonable if they disappoint or anything like that. There's an economic soft patch, on and on and on. There's lots of reasons it could come back down, but we just don't know when those will happen. So really what you want to do is follow a lot of these stocks, which is what I do, and then wait for them. Let them come to you rather than you going and chasing after, feeling the FOMO and feeling like, oh, you missed out on whatever this move was, Well, just as a couple 100%. Well, just as an example, they went public, right? And they immediately rose 100% pretty much after this initial dip. And you could say, oh, I missed out on 100%. Well, yeah, but you still got you also missed out on this 60% decline. You would have lost money. You would have been underwater 2 or 3 years later, 30%. And these declines happen. And if it's a quality business, that will be a time to go ahead and buy. But I think the question with Uber probably is just how much growth do they really have left? How much can they really expand into markets and then defend those positions against local competitors and things like that? So that's going to be the real question. And you don't want to overpay when there's that much uncertainty with a business like this, in my opinion. So paying a fair price is okay, but you don't want to pay too much. It makes a difference between, getting 100% return in something and a 50% return. I mean, it's a huge difference, paying, half of 70 instead of paying 70. So, and usually you can get that opportunity with a stock like this. I definitely think you are, because it doesn't look like they're growing as fast long term, probably, as the market is thinking short term. And that means at some point they'll probably sell off. Okay, hopefully you found this useful. If you did, hit the subscribe button. And I'll see everybody later. Bye.